Learn price behavior to master the market advantage. Hello, this is Bella. Welcome to my series of instructional videos on price behavior. In the previous course, we have already learned the basic part, understanding the basic K-line form and correctly feeling the bullish and bearish forces in the market. If there are not to study friends, can go to have a look. Today begins the second part of our teaching sharing, learning about basic form and structure. Price movements always repeat some fixed behavior patterns. If you can master these patterns, it will be of great help to your chart reading and trading. In this part of teaching, I will divide these patterns into three parts, which are trend pullback, trading range and trend reversal. We will first talk about trend pullback. Trend callbacks can be divided into simple callbacks and complex callbacks. Simple callbacks refer to simple movements of one or two segments, while complex callbacks refer to complex structures of multiple segments. I want to make one point before we start. And I've said this many times. If you are still in the trading novice stage, do not worry to use what you have learned in trading. A form will have many variations, and when a form fails, may immediately form a new structure, and a form structure, in different market conditions, appear in different positions, representing the meaning is usually different. It is difficult to grasp these changes before the novice learns to understand them. Most traders should learn the double top and shoulder top and bottom form when they are just getting started. Many people learn to trade immediately after they finish, and then lose a lot of money. In the later stage of my video course, I will teach you how to integrate the knowledge learned and use it, so don't worry. In the early stage of learning, what you should do is to combine the content of the channel to review and think, and ask me questions if you don't understand. Let's look at a specific case of a simple callback. The red arrow marks a very standard, simple callback pattern. I'm going to use this form to show you some definitions and some considerations of a simple callback. Let's start with the uptrend. First of all, you have to have a clear and rapid strong movement, and the strong movement should break out of a sorted range, a big break, so that people who see this picture on the floor feel that the bulls have dominated the market at this point. Because you only have a clear trend in the clear trend of your pullback, if you are in the shock range before the rapid movement, no breakthrough key points in the main field, the main participants in the field do not think it is a clear trend. Then there is no pullback this term. To re-emphasize the first point, there needs to be a clear, strong trend for you to follow. Second, the trend of the callback must also be simple and clear, not horizontal overlap of a lot of this overlapping K line up, such as the right side of this overlapping K line. The horizontal K line, which is the trading range, and this is one of the things that we talk about a lot. Let's say we take this period of rise, and the price moves rapidly to the top of the band. And then we do a horizontal overlap of 5K lines, and then we do a downward adjustment to the area where we're going to enter. Because the horizontal overlap of K lines is the trading period, there's a trading band that's formed above the band, and after the pullback, on the way up, that trading band is a clear resistance to the upside, and we don't want that clear resistance to the direction of the price when we get in. On our trading is a negative factor, so we trade this form of the second point is the wave callback trend. If the simple clear a healthy slope of the third point is to have an entry form, very good example. At this point, if a trend has been running for a long time, don't end up trading simple pullbacks. To sum up the conditions for the establishment of a simple pullback, the first point is that there must be a round of rapid trend movement. This round of movement must make people feel the obvious trend power. It is best to break through the obvious finishing interval, break through the obvious band points, break through significantly. And that's what we're going to follow. Second, the pullback should be simple and clear. It should not be too many horizontal overlapping K lines. If there are too many horizontal overlapping K lines in a pullback, it is a small trading range. It's a significant resistance to the direction of our price movement after we enter, and we don't want that resistance to the direction of our price movement after we enter. We want to avoid it. Third, it's better not to be a trend that's been running for a long time without a pullback, because it's prone to a long and complex pullback, And if you think about a trend that's been running for a long time where the trades that started to build up and start to operate have made big gains, they might start to take profits. The contrarian traders who have been sitting on the sidelines will also take advantage of this opportunity and start moving in to take control of the market. Since the market is likely to face a complex correction, this should be avoided. Next, I will take you to understand the feeling, how to operate this simple form of callback in a real dish example. Let's look at the first example, which is the drawing we just used. Let's remove the K line at the back. Let's get a feel for it. Now you get this drawing and the price goes here. What do? The first thing you have to do is map out the key level of the market and see what the market is doing right now. Okay, the first level. How about some of you, and you can see there's a break in the convergence zone. Of course, I'm not a big fan of that and the price movement here. The first thing is a sharp rise through a convergence zone through a key band point, and it's a big break. Now the market clearly has a bull advantage and then the price has a simple pullback, and we can see that it basically has no overlapping K lines. There are two long short trend K lines, and then there is a reversal K line. So now the price has been applied to the region exactly to test this band point. And it also happens to be around 20 EMA. And what about this 20 EMA? It is a reference index for us. The area above and below 20 EMA is a reference area for our simple callback into the field. We should not over-rely on it. Some people he will be overly dependent on the moving average when trading, and then to such as close to the moving average to do, this is not right. In this area, we need the market conditions to allow us to do it first, and then if there is a good entry pattern we will trade. We can't rely too much on that. So this inverse K line, what does it reverse? What reverses is where does the cycle move into the trend direction. It appears in the horizontal retracement near 20 EMA where we are ready to enter. So that's a very good signal, K line. How do we enter? We wait until we go up the hill. And as soon as we go up we're on the road, or we hang a breakout order and we put a K line under the price and break the previous day's K line high, and then we go in. There are some people who will come in as soon as they see a reversal of the K line. That's one way, but I don't really recommend it because when the market reverses the K line, is a signal to establish the signal to break the price to the bull, to show its strength, to break the signal to establish the entry. Then sometimes this K line it may not break at all. Directly continue to go down. Then if the direct entry of the person, he is trapped, at least I personally wait until the upper will enter. Then we continue to look at the next K line. The next K wire is our K wire, the one on the left. The one that reversed the K wire is called the signal K wire, it's our entrance signal. The next one is our entrance signal. So this configuration is the one we have now, it's called a breakthrough. The first breakthrough is called high one. Let's see how the subsequent price continues to go. He issued two crosses behind the K line of our entrance. In fact, this is not a very good signal, because we hope to see the continued strength of the bulls after the entrance, but he received two crosses, which means the price still stops. At this point, you can wait and see. So the third K line is the K line that's coming out now, and it's going to exceed the high point of the previous line. So let's take a closer look at this, and some people said it's a bit tricky to define now. Let's take a closer look at the K line. That's now the red arrow is our entry line. It's going to exceed the high point of the previous reversal line. It's going to break for the first time and it's called high one. Okay, so let's look again at the latest K line, and it goes over the top of the front door K line twice. So we can look at it the first time, the second time. Is that okay with you? So this is the entrance pattern of the sophomore year. We just talked about this is the first time the freshman year first broke the entrance pattern, and this is the sophomore year, which is if someone is here and they don't enter. They see this signal and they see the bull's second force signal, they might enter the K line over here. Okay, so let's move on and listen to the fact that after he came in sophomore year of high school he closed another K line, which is the bear power line. Let's take the positive line out of the back. We can see that the price has gone up. Here is a lot of overlapping. This is a trading range, this pullback. A pullback is a trend at a small level and there's a period of down energy. Down energy stops here. And there's a small trading band, meaning down energy stops, so what if there are still people who haven't bought in here? They may choose to enter again above the high of this K line, because it's a short. Small trading band, this handover on the break may be some people's entrance signal. It is called box breakthrough. We recall our several entry form: high 1 breakthrough, second breakthrough, high 2 breakthrough, and box breakthrough. This is the most commonly used entry form we do. Simple callback. Let's go ahead and look at it. Okay, on this positive line, it's a strong bull. It's telling us that the bull is making a strong move, and whether we're in high 1 or high 2 or the box is breaking in and the signal is getting confirmed, and it's getting confirmed. Alright, so this is how this pattern trades based on its target level, and I'm not going to talk about that for the moment, and I'm going to talk about it in future videos, because this is a separate science of profit and profit exit order management, so I'm going to talk about it in the same way, but you just need to know how this pattern trades. Now the second case, when you get a graph you have to figure out what the market is doing. Let's draw the levels. We've plotted the key levels. What is the market doing? First, the market had a very strong rally, and then the market had a correction, and this correction, this cycle, is a complex correction, and it's multi-stage, and we'll talk about that later. After the pullback ended, the market continued in the direction that it had gone up, but that run of energy ran out pretty quickly, and it told us that the bulls were not willing to keep buying. That the bulls were not strong enough to push it through the previous key uptrend, pattern, and we'll talk about that later in this video on simple pullbacks. When the market fails to rally and breaks through the critical level defense, that tells us one thing: the bull has given up. He is not willing to defend the level he has defended many times. He is only willing to buy at a lower price. Good price after the break, quickly rebound. This round of break is a rapid break. I believe you can see directly that this round of rebound is also a rapid rebound. This is we are very willing to operate the form, rapid decline energy, rapid rebound at the average. When the price movement here, we have to find the entry form. First of all, we can see a low 1 is the low 1, a short form of the first break, but it was rejected by the market, saying that it is not recommended for everyone to do. Low 1, high 1, low 1, everyone just needs to know this thing. So why was this rejected successively? And it's easier to understand because I already have 3 overlapping K lines. It's a trading range, and ranges are prone to false breaks like this, and that key signal, the K line, the negative line, it's a small K line, the small K line as a signal. The good thing about the K line is that it has a narrow stop loss, and the second thing about the K line, it's the one that broke the previous high, and you can see that, after he made the high, he took a long short body, so it represents a false break to the upside, and if this arrow, this signal K line gets spooked, it's a low 2-2 short pattern. Does that make sense? This is the same as the rejected first break is a lower one. So if the K line of this line is broken by the subsequent K line, it is the second break and the second short form of the second break, which is our K line. Then when the price falls below the previous low of the K line, I will enter the short market. I may enter the short market directly over the break order. Alright, so let's look at what's going on, and what's going on is very simple, and he confirms our short signal. So this is a very simple pullback pattern, and I'll summarize. First of all, the market background allows us to short the rally, adjust the rally, and break the market has turned short. In the case of the short trend, there is a sharp decline in the energy of the rapid rally correction, and there is an entry pattern. A second form, we entered the short, simply gain. Let's talk about the third case again. When you get a chart and you want to trade, you want to figure out what the market is doing right now. Let's look to the left. There's a very long down movement, and then there's a complex correction, and the pattern of the correction is called the wedge correction. We'll talk about that in the future. After the pullback, the downward trend has continued, and the downward energy looks good, meaning that the downward trend hasn't changed, so it's just a simple pullback. And we see that this cyclical upward correction is what we want to see, and it's not overlapping, and it's going up very quickly, so we're going to look for the entry pattern now. When the price movement here, we have a K line. Let's see, it has a first break here, and we see the low of this K line. Let me put an arrow here. We can see that the current low of the K line has broken through the previous K line, the aggressive traders are going to go first, but personally I'm going to divide, unless the first breakout signal K-wire is very good like our first case, which is a forward reversal K-wire. I'm probably going to participate in the first breakout, if not I'm going to wait for the second breakout. So let's go ahead and look at this, and we've got one in the back, which is a negative entity, but it overlaps the front quite a bit. This is a non-trend K line, so if you're a first-time buyer and your short order hasn't been confirmed by the progress of the market, let's keep watching. This is a very critical K line. What do you see today? For those of you who are smart enough to see that this is the K line that we really want to see, there's a false breakup, and a false breakup is a very important trading concept, and I'll probably do some videos on that in the future. There's a false breakup, and then there's a second K line that falls below the previous low. So here's a variation of the second break. We can't count the second break yet if we just look at the low K line, because it's always the low lowering K line, but as I said before, our second break refers to the two efforts on the opposite side, and now it's a daily chart. Let's look at it when we're young, let's look at it when we're at 4. So the overhanging negative line is an upper effort followed by a lower slope, and you can see that if you look at the small level, it's a double break, it's a short double effort. It's a variation of the double break, and you'd better try to understand that the overhanging line goes up and then down. It represents the first short force and the second short force, so it's a second break in the entry pattern, and that's a very good signal that the K line is also the entry K line. So let's see what happens to the price after we enter the market. So we can see that the market confirms me immediately after we enter the market, right? The logic of our entrance. So to sum up, this trade is very simple. First of all, the whole market, it supports you to short, then it gets to where we're going to short 20 EMA, and then it gives us the pattern of the signal to short, and we short the profit trade, which is also relatively simple. So let's move on to the fourth case, where the old rule is we get a chart and we analyze what the market is doing, and we draw key levels, and we see on the left side of the chart we have a very strong rally, and we have a pullback. A simple pullback and then a complex correction. This complex correction is actually a wedge variant that we'll talk about in the future, where the bulls have a strong push to a sharp rally, and then the price adjusts, and then they break up here, and they continue to do long follow-through without much follow-through, and they make a false break. They can't break out of the previous high, they can't break out of the previous high, and they also can't break out of the previous small high, so this represents the lack of strength of the bulls, and then there are the bulls breaking down, which is very similar to one of our previous cases where the bulls are unable to break up and the defense is failing down because the bulls don't want to buy anymore, they just want to buy deeper. How deep is it? It's going to have to be specific price behavior, specific analysis that you can't predict. Again, if you had someone who knew how to fake a breakout, it would have been short. For him has been against the logic of his judgment. He came out. There is another, is that your entry logic does not change. You do this short above as long as not broken, you continue to hold. This is also a kind of trading logic. Let's move on. Okay, the price has given us a very good profit margin so far, but we may not do this trade. Let me summarize. First of all, the market allows us to short. It's pulling back with so many overlapping K lines that everything behind it is starting to look a little bit out of shape, and it's a little bit weird if you're a conservative and you're a moderate. This guy, just give up and don't look at this next segment where the profits are so attractive. This is a very uncertain pattern. Your trade win rate has been reduced. Now we're going to start with our fifth case, and I'm going to start with this case, and I'm going to go through it a little bit faster, because I prepared a lot of cases. And then actually going through it turns out to be a little bit more time consuming than I thought it would be if I went through it at the same pace that I was going through it, and I would have read it in an hour. So again, we have to look at what the market is doing to get this graph right. We can see that there is an upward trend in front of a simple adjustment to continue to rise rapidly, the market followed by an upward channel. If the group of members listening to my lecture already know that this is a speed and channel form, it is often easy to break and then back to the starting point of the channel. But in order to facilitate, the friends who have not heard the class can also understand, I talk about this case from other perspectives. This whole thing is a sharp rally. This whole thing is a pullback. And one of the things that this crossline tells me is that these two segments are down pullbacks that break up, and you can see that directly from the daily chart, and a lot of people can't see that, so let me show you on the mini cycle and show you. This is a skill that you must develop if you want to become a day trader. I was on the daily chart and now I'm going to go to the mini cycle, and we can see one pullback and two down pullbacks, and the rally that follows the down pullback is pretty feeble. Right? If you can see it directly from the daily chart, you don't need to look for this pattern in the mini cycle of the tangent line. As I said before, the trend up energy adjustment continues to rise, but the continuation is weak and it breaks down, then it's a short biased market. And let's plot the key levels again: rapid decline, rapid rise, simple pullback. That's the pattern of the simple pullback that we're going to trade. We're now going to find an entry, logical entry pattern. By the time the price moves here, he has shown us a 3-enveloped K-line form. The 3-enveloped K-line form is a convergent interval over a small period, and since it is a convergent interval, you can give it a break. So if he breaks, it corresponds to one of the logic that we want to short. So if he breaks, we will enter directly and at the same time at the K-line. We also see it retesting the previous breakout point. It's a contented verification position, and that's one more reason to go short. We continue to see in the price to break the low point of the K-line is the arrow low point of the K-line when we have entered the market. We now continue to see whether the subsequent trend of the market has verified our style of logic. Let's see, it goes down and then it has a simple pull-up adjustment to go up no matter how you interpret it. But let's look at the K-line. Can you see that? We're not going to look at the triple D pack, we're going to look at the low of the K-line. So on the left, we're going in here, and it's actually a first break and the first break, and then the down energy doesn't get extended and it goes up again. That's a second break, the second low below the previous low of the K-line. And if you don't get in ahead, then this is a second short, a K-line entry pattern. Let's move on to the following trend. Up to this point, the market has given us a very favorable profit target. Let's not look at the rest of it. I said before that all the patterns of secondary breakout are prone to form double tops and bottoms in the small cycle. So let's look at it again. By the way, we can see that we can break two tops in the small cycle. The second breakthrough in the big cycle is the double top and bottom in the small cycle, so I hope you can deepen your understanding of this form. Okay, so let's go back to this case, and let's go back to what the market is doing. First, there's a sharp rise, and then the price is adjusted, and then the price goes up, and there's a good trend to go after. So here's a little point. Some people would call this movement a breakout pullback, but in my system, in my analytical logic, it is called a breakout failure. The first positive line is the downward trend after the breakout, which is called a breakout failure, and the last upward line is called a breakout failure, which is a breakout pullback. Then some people might ask, why don't you just call it a breakout pullback? Why is it called a breakout failure? A breakout failure, this is really the difference between an analyst thinking logic and a trader thinking logic. Let's say we take the K-line off the back and the price moves here, so when you look at this graph, can you tell if it's a breakout correction? You don't know it's a breakout pullback until it continues to go up. You don't know it's a breakout until it's a successful breakout. When the price operates at this point, the breakout fails for the trader. The subsequent rally is called a breakout failure. This is a little bit of a point that you can just listen to and don't have to understand. So when the price is applied here, first of all, let's see that the decline is a simple decline, but in front of the decline there is an overlapping K-line, which is not what we want to see. But if your long logic, your profit/loss ratio of the order is higher than the money, it doesn't matter, and let's just look at that pattern and see if there is any further movement that we enter. It doesn't make any sense that the next K wire is going to be an inner wrap wire. So this is actually a first break long pattern, and some people and some educators might get involved when they break the previous K high in the surgical break, but I personally don't like to get involved in this trade. Let's see if there's a second chance in the back. We see that the signal of the first break was rejected by the market. The price we expected at the beginning was a simple pullback of one stage. But the market rejected our judgment. In fact, the second stage of a pullback and the two stages of a pullback are both simple pullback forms. Because they are simple pullbacks in the market, then when the price movement comes here we find a little bit more, he pulls back the previous breakthrough point, which gives us another logic to go long. If this gives us a signal to go long K line, we will participate on no. It is still a non-trend K line. Okay, how do we understand that? You can understand it as a secondary breakout. Let's say the first breakout is here and this is the second bull breakout, or you can understand it as a two-stage pullback entry pattern, so being long here is logically a very good trade. The most we can do is to break through the previous K line high. Not to say that the K line is coming out, we do. The break of the previous K line high verifies our long logic we will enter. So let's move on and see what's going on in the future. And for the short-term trader, these three big positive lines are perfectly closed. And here's a side note, which is the idea of an open-ended ride. All corrections we call rides, and bull market corrections are called bull flags, and bull market corrections tend to break up, and that leads to the continuation of the bull market. And the energy for the continuation of this bull market runs out immediately, and that correction ride is what we call the unended ride. And what it can lead to is that the last leg up of the trend is a potential reversal pattern, and I'll talk about that at the reversal station, and you can start to understand that you can use this idea to understand why the market turns, because it's supposed to be a continuation of the energy. The trend energy is not sustained, so it reverses. Alright, so that's it for this case. All of our previous cases were one-stage callbacks that brought good entry and good returns. But this time, the one-stage callbacks are turned into two-stage callbacks, which is also a simple callback. If you're interested in the way I analyze markets, and if you're interested in price behavior and want to learn more about it, you can look at the description at the bottom of the screen and join our membership group and talk to me in depth. Every working night, I would share my trading experience in the member group, and the property would provide answers to any questions that the member group had about the transaction. You can also leave a comment at the bottom of the screen with your questions or your thoughts, and I'll talk to you when I see it. The usual way we look at what's happening on the chart, what the market is in, is that first the market has a sharp decline that's very deep, and then it has a complex correction that is actually a wedge correction, a wedge variant of 3 pushes 1, 2, 3. Do a second movement in a single direction to you. It's a very conservative trading pattern. It's my favorite. What about the first break? Like the first break in our first case, if the signal of the first break is a very strong signal of the K line, in that case it's a strong reversal of the K line. If the first break is a very strong signal of the K line, I'm only going to participate, because there are many variations of the form of the box break. It may be difficult for me to explain it clearly when I actually talk about it. So I will not talk about it directly. And the box breakthrough is actually in the current market is rarely encountered this small box, then we can give it up. When you finish this course, you can pay more attention to the entry form of the first breakthrough and the second breakthrough. Alright, so that's it for today. Simple callbacks look easy, but they're not easy to deal with in practice. The trading pattern is to determine the overall state of the market, whether to allow a simple pullback to establish a trend rather than a correction to be clear, and this pattern of trading opportunities are often fleeting. It requires you to have the ability to quickly read charts and make decisions. You can look for this pattern multiple times and observe when it is established and when it fails, and how the market behaves before and after that period. On a small cycle chart, the market is very easy to form a trend. But this form is really not as easy to master as it seems, and there are a lot of failed forms that I'm not going to talk about because I don't have enough time. I'm not going to talk about stop loss and target because the departure principle is an independent discipline. And everyone should choose the ideal way that suits them best. There will be a separate video at the end of the course on order management, and that's it for today. In the next video, we're going to talk about complex callbacks, and complex callbacks have a lot of shapes, and we're going to do multiple videos on complex callbacks, and if you like what I'm doing, you can like your comments and support it, and we'll see you in the next video.